Yeah, welcome to my YouTube video channel, Questions of Doubt in Corporate Valuation. My name is Bernhard Schwetzler, and our today's question of doubt is there something wrong with unicorn valuation? So let's start by looking at the definition of unicorns. Unicorns are non-listed, privately held companies valued at $1 billion or more. Yeah. But recently, some investors and analysts start to feel uncomfortable with the high valuations. You see here, this is a title picture of The Economist, where you see some ponies disguised as unicorns. So people feel a bit skeptic about the valuation of these unicorns, and I would like to highlight today a particular potential flaw in the simplified valuation metrics that are frequently applied on these corporations. Yeah. Okay, so let's look at how the valuation is going to happen usually. Mostly what you see whenever a value is communicated, it is directly connected to a financing round. You see here Uber financing round, 62 billion, Airbnb, 1.5 billion funding round, 25.5 billion valuation. And the matrix that is applied is quite simple. The idea is that if an investor pays 10 billion for a stake in Airbnb and she receives 10% of the equity, then simply the metric is if you pay 10 billion for 10%, then the total value must be 100 billion. Yeah, as simple as it can get. So it is usually, it's called and referred to as the post-money valuation. You simply apply the ratio of price paid by the venture capitalist or by the investor to the received equity stake. Yeah. So, and there is a problem, especially when venture capitalists are going to make these investments, because as you may know, venture capitalists attach usually a lot of additional cash flow rights, preferred rights to their investments. Yeah, and of course, all these special additional rights are part of the value that they attribute to their investment. Yeah, I just picked out the most common one and the most important one. That's the so-called liquidation preference. The idea is that this liquidation preference, or LPs, as they are referred to, govern the distribution of the exit proceeds. So the idea of such a liquidation preference is that you get a preferred treatment, yeah, that you first get your money back, and then the other investors, usually the founders, get their investment back. Yeah. So in that sense, this is a special preferred treatment that you get. You may distinguish between single and multiple LPs. That means how often your investment is paid back at the exit before anyone else gets something. And of course, also an important distinction is it participating or is it non-participating? That means, are these proceeds in earlier steps taken into account in later steps of the distribution? Yeah? So this LP gives the venture capital investor a preferred treatment over all the others. Yeah. So, and of course, this is part of the price. Yeah. Here is a slide that shows that such preferential claims, there are some others, for instance, down round protections. These preferential claims are of high relevance in venture capital finance. There are only a few deviations. You see here the black bars. This is the first distribution to the venture capitalist due to the preferred treatment. And then you see here the white bar, or the white part of the bar, is then the rest that is distributed. And you see that it's quite common that first the venture capital investor gets his or her money back, and then afterwards the others get something. So what does that mean for the valuation? That means for the valuation that this simple matrix that you simply proportionalize the investment and scale it up to 100% is not working anymore. And I'd like to show this with a simple example. Let's say an investor, a venture capital investor, pays €1 million into a startup company, and she receives 50% of the equity, and on top of this, a single LP. Yeah, and that means that she first gets her $1 million back, and then the other investor, 50%, gets his or her investment back, and then the rest is split 50-50. Yeah. So let's first, you see on the left-hand side the graph, without this special treatment. And then, of course, this pro rata and this simple mechanic valuation would properly apply. Yeah? You see here, this is the exit proceed, and this is the petition for of the exit procedure into the two investor classes. So you see that this is the 45-degree angle here, the line, and you see the red line is then simply the 50-50 split of all the proceeds. Yeah, so every proceed or any proceed that is showing up at the exit is exactly split 50% into the pocket of the VC and 50% into the pocket of our founder. Yeah. So then, of course, you may easily apply this simple post-money valuation mechanics. So if you pay 1 million for 50% of the shares, then obviously the total company value must then be 1 million divided by 50%, and that's 2 million. Yeah? And that is working out in this particular case as nobody has some preferential right. Yeah. But now let's look at the right-hand side of this slide. Here you see the actual treatment of the distribution of the exit proceeds. Yeah. So you see that our venture capitalist investor gets first his million back. So you see that this is then along the 45-degree angle line. And then you see once you have your money back, that is the million that you have invested, then the catch-up of the common shareholders of our founder is going to kick in. Yeah? So then, of course, the second million goes into the pocket of the common shareholders. And then if the exit proceeds exceed 2 million, then we have this 50-50 split suggested by here, these equity fractions. Yeah. And of course, now, if you pay 1 million for this, then of course you additionally get the payments here. This is this orange shaded part on this graph. And this is, of course, part of the value of your million that you pay for. Yeah. And it's clear that as you cannot give the same preferred treatment to the other 50% of the shareholders, because then, of course, it would no longer be a preferred treatment. Of course, the value of their shares must be lower than 1 million. Yeah? And the simple conclusion from that is that, of course, the total value of the company cannot be 2 million. Yeah? Because, as I said, you cannot, in that sense, give this preferred treatment to both of the parties, because then, of course, it would be no longer a preferred treatment. Yeah? So the total value then must be lower than 2 million. And the consequence is, if you apply this simple mechanics on this situation, you always end up at a company value that is upwards distorted. Yeah? You overestimate the value of this company. And this is not just a simple and single thing, yeah? Because many of these firms have several financing rounds, and of course, in each and every of these financing rounds, there is a liquidation preference, and if they are stacked, that means that the latest investment has the highest priority, then the second latest investment has the second highest, and so on. Then, of course, the misvaluation and this overvaluation effect may amplify. Yeah? And so then you may get significant deviations between this simplified method here and the true value of the total company. Yeah? So I just would indicate how you might adjust for this. Yeah? You need, as you already see from the slide here, the key for the solution is option pricing theory. Yeah? So you see here, for instance, if you structure here the value of our venture capital investor, including this liquidation preference, then you see what we have here. This is the value of the underlying until his investment. And then, of course, you have a capped call, that is, you are short in a call here with a strike of your own investment. Yeah. And then, of course, the second component or the third component of the value is then another call with a strike price, in our case, of 2 million. So then, of course, the new distribution kicks in. So you may use option pricing theory in order to extract this distortion and arrive at the lower value of the company. Yeah? So what I would like to highlight here is a very influential study coming from the US, from two US professors, Gonal and Streboulaev. and they have been looking at a sample of so-called unicorns, and they used this option pricing theory idea in order to extract the misvaluation. Yeah, and they came up. You see here the distribution of the overvaluation. You see that in some of the cases they came up with an overvaluation of almost 200%. Yeah. So, and what they claim here, these financial structures and the valuation implication can be confusing, of course, and are grossly misunderstood, not just by outsiders, but even by sophisticated insiders. Yeah, that means that they say that even venture capital investors may, in that sense, get distorted values by unintendedly ignoring this. So that may also be one of the potential explanations that we have been facing in the recent years. That was that the private valuation, this unicorn valuation, was higher than actually the IPO proceed and the IPO valuation that was reached at the exit. Yeah, so the most prominent case here was Square, that was a mobile payments company with the last financing round was valued at around 6 billion. You see this chart is from The Economist. And then the offer price for the IPO was just, I think, 3.4 billion or so. Yeah, so a huge gap between the two. And there are voices, and of course, I also would join this argument that one of the reasons is the inflated valuation that you get by simply applying this flawed mechanics for coming up with this value of 6 billion then. Yeah. So that means Julian Cabot, Maximilian Schreiter and me, we have also been doing some research on this for European sample, a smaller sample, and we also end up with a significant overvaluation when adjusting the value for these liquidation preferences and these special rights. Yeah, so on average, you see here, we end up at 20 to 22% average overvaluation. Yeah. So what can we say then? Indeed, some skepsis is justified when looking at these simple post-money valuations. Yeah. So there is a tendency that applying the simple metrics is yielding significant overvaluation of the companies. Yeah. But one also has to say that the basic valuation problem of the company is in that sense not directly solved by the proposed adjustment. Why? The adjustment assumes that the venture capital investments, technically spoken, has a zero net present value. That means that the venture capital investment is fairly and correctly priced. Yeah, because then the idea is, the conclusion that we draw is, if the venture capital investment is fairly priced, then the total firm value must be that and that. Yeah, so in that sense, back to our example, our assumption is that the venture capital investment, including the liquidation preference, has a fair value of 1 million. Yeah? We do not ask, and we are not able to tell how the venture capital investor is, in that sense, getting to this valuation. And that means that we still do not have a complete model to determine the fair value of the venture capital investment, and by doing so, of the total company as a whole. Yeah? So here are the two papers that I've mentioned in the videos. So this is the Golden Stable Live here, and this is ours. And you may download them, you may even read them. I hope that you find some good arguments in there. That's it for today. Thank you.